Well, let's get across the market now with Jimmy Jiang from Macro. Jimmy, great to have you on. Happy New Year. Now, we saw a sell-off overnight and that pushed down US stocks.
Good morning, Oliver. Yes, quite a disappointing day last night. Dow Jones only rose about 0.3%, but the Nasdaq slipped by 0.1%, and the sector performance was quite varied, obviously around the healthcare, the materials and the consumer staples were the winners, but the communication services obviously lagged. So in the economic front, we're seeing some mixed signals. So the ADP data showed that the private employment rose by 122,000 in December, falling just short of expectation, but the weekly jobless claims dropped unexpectedly, but continuously, seeing those claims increase. So looking ahead, we got the non-farm payroll report that's expected to show some bit of a slowdown as well. So I think it's forecasting around, let's say, 163,000 jobs added versus the 227,000 in November. That kind of reinforces that narrative of the cooling labor market, which obviously could influence the Fed's next step as well. So we got to kind of take a step back now and see a little bit of a bigger picture because of the starting of the new year. So we're just going to see what could potentially impact the Australian share market moving forward. So we're seeing that a lot of uncertainties across the global markets, not just in Australia, but also in the US now with what the central banks might do. So we're seeing a lot of those bond prices falling, and the bond market is more volatile than we've ever seen in a while. And in Australia, a big wave of that refinancing of the mortgages for a lot of Australians is coming this year. And that's going to put a lot of pressure into a lot of companies like the consumer discretionary, even in the consumer non-discretionary potentially as well. On top of that, another risk that we're seeing is that the US and the economy is clearly slowing down, and we're starting to see that show up in the not just in just broad market, but in the housing market in particular. And that's still concern around further about the potential impact of those trade policies that might develop further with the new government in the US, more particularly in the Asian market, and also focusing in China. And that's something we're watching very closely because that could create challenges for a lot of Australian resource sector because China is the biggest customer when it comes to our resources. So that's something we need to be very aware of because it is taking up a quarter of our market. So and a lot of our clients are exposed quite heavily into the resources. So we're kind of coming up with some different thematics to make sure that we protect ourselves in the potential downside that these potential risks could impose in the Australian share market. So it's very probably the best time to right now to maybe reevaluate what other positions that we want to reallocate in our portfolio starting from today.
And Jimmy, as you mentioned, you're concerned about those potential tariffs. And overnight, President-elect Trump said he was contemplating calling a national economic emergency declaration to get those tariffs pushed through. Do you have concerns over that?
Yes and no. It is very important that we should be wary and be concerned around that. But for trade policies to develop that quickly, I'm not sure. Again, it's very difficult for that kind of push to come through as quickly as Mr. Trump will ideally want. But whether that can take in place very quickly, it's very uncertain. It's a game that macro don't want to play because it is a diplomatic issue and it can change overnight with their stance. It depends on the development of the relationship between, let's say, the Asian market and in the US. So we obviously saw the Prime Minister of Canada stepping down as well. That's another big concern that we have, just because if that's the case with the new government coming in Canada, how they're going to be playing against the Asian market, because they are very getting concerned with the overflow of the immigration into Canada and how they're going to develop their trade policy around that as well. So we're kind of in a position where if it does proceed further and the trade policy develops, then we understand the market will react pretty quickly. So even though that trade policy might not enact straight away or in the next 6 months, but if that trade policy develops a lot more quicker than the market anticipated, then the market will definitely react. So we definitely want to be aware that the resource sector in Australia, for example, is going to be one of the first sector that's going to be hit with this kind of trade policy being developed. So definitely being being wary, and we're not allocating anything further to the resource sector.
And Jimmy, macro's positioning in the current climate, you say you're continuously bearish in the short term.
Yeah, absolutely. So in a market like this, it's important to stay cautious because not only we're on uncertain around what the Australian market will do, but now we're not even sure what the US market will be looking like in the next 6 to 12 months. So one way to kind of protect this kind of potential downside or the uncertainties is considering some hedging strategies that's available in the market that will protect us against downside risk. So we have tools in the market like Bear ETF, BEAR, or the BBOS ETF. Now these two are shorting positions, which is an inverse reaction against what the market will do. So if, for example, for Bear, it's a 1-to-1. So if the market goes down by 1%, you will gain around 1% exposure. Whereas BBOS is a leveraged exposure. So yeah, if the market goes down by 1%, you'll gain roughly between 2 to 2.75 times of the daily movement of the S&P and the ASX 200. So, but that comes with a higher risk. So I want investors kind of consider this as more of like an insurance policy rather than you trying to gain from the shorting exposure. Because at the end of the day, if, for example, if the market goes down, then your majority of your positions in your portfolio will be down. So it's more of a like the protecting yourself from the downside rather than trying to gain from the shorting exposure. So that's probably really good exposure to have in your portfolio right now.
And today we'll get retail sales data. Will a strong figure lessen the likelihood of a February rate cut?
It's very difficult to say because at the moment, what's really important for the Fed is to cool down the inflation and with the outlook of what the new government will be doing, like at the moment, it's not looking good for the Fed because a lot of the policies that's going to be continuously developing over the next 6 to 12 months are very inflationary around the tariff, for example. And if that's the case, then the Fed just has to, be a lot more cautious than they already were, and they made that pretty clear in the last meeting as well. So our bets are probably at the moment, the Fed probably going to hold in cutting any more rates in the short term, just because there's definitely cooling down, but the outlook is just not looking that there at the moment. So that's probably something that a lot of investors should be wary at this stage.
And the February RBA meeting will be the last meeting with the current board. How do you see the new board impacting monetary policy?
There's a $1 billion question there, Olivia, because what the new the board will do, it is again very uncertain. But one thing that is certain is that it is inevitable that the RBA will have to cut rate at some point in the next 6 months, just because first of all, the inflation is cooling down in Australia, not as quickly as the market has hoped for. And also in the US, if we see the further rate cuts being imposed in the federal, then Australia must potentially follow. Another thing that might accelerate that rate cut is the resource sector. So, for example, the resource sector continues to suffer even further, then the economy will definitely slow down even faster. And also, following that, a lot of the job data will show some more weakness as well. So if that's the case, then we might see some further acceleration of the rate cut. So we're in a lot more positive side with the Australian Reserve because we're highly confident that the Australian Reserve will probably potentially cut rates sometime in the next 3 to 6 months, and that's what the watch tool is showing as well. So definitely positive in that regard.
And Jimmy, just finally, what sectors do macro see performing in 2025?
At the moment, uncertain markets like this, a good kind of sector is they're very defensive, as boring as it may sound. So some of the sectors that we like right now is industrial. So we got a very good companies that has been underperforming or even undervalued right now. So one of the big company that we like right now that we've started to allocate as of last week is a company called SGH Limited, and the ticker code is SGH. It's more of an investment company, but they have a huge exposure in the industrial services, media, and investments. So their core businesses is like WestTrac and Coates, which are very performing well and very resilient customer activity, and they have a strong, service demand as well. And at their recent AGM, they affirmed that their financial year 25 guidance is expecting a very high single-digit EBIT growth, and that aligns very closely with the market expectations and highlights their ability to deliver the consistent earning growth. So Coates is my absolute favorite business in that basket, and in the industrial sector, they took very resilient against the potential market downturn. The only concern the market or the investors should be wary of is the continuously falling of these builders and construction companies in Australia. But we're quite confident that the Australian government will take some measure in place very soon, because we are short of housing, so we need a lot more housings to be done in Australia, and there's going to be a lot more support, as we have seen with the resource sector, with, let's say, the recent time, the Western Australian government giving a big support, financial support to the resource sector companies. So industrial sector is our favourite market right now.